What's going on, everybody? Cullen Gandy here. Today I want to do a mortgage education related video that has to do with one of the most asked for topics in the NMLS SAFE Test, which happens to be that around the math portion of the test. In this particular video, I will be covering not only math that you may find on the test, but math that I have personally found useful in the course of working as a functional mortgage loan originator, because sometimes the system's shut down and you need to know your business, otherwise you might get some cranky customers and some cranky management. And as always, if you enjoy these educational type videos that prepare you for the SAFE test, go ahead and leave me a like and subscribe to the channel so I can go ahead and bring you more value. To lay out what I will be covering in this video, I will be covering how to qualify income, how to come up with a monthly interest rate, how to come up with a monthly mortgage payment amount, how to calculate things like debt to income ratios for the qualification, and how to come up indeed with an amortization schedule, because that is something that is highly automated right now, but I have had systems shut down and had to, sort of press my luck writing it all down by hand before. So this is something that you're going to want to know as well. To be starting off, I'll be covering how to qualify income, because a lot of times clients will give you what they earn in a year or what they think that they earn in a month, but if you don't know how they're paid, you don't necessarily know if you're calculating the income correctly. The first type of income that I will be talking about how you're going to be calculating is that of the hourly wage earner. As you'll see here, you have a person making $17 an hour, and of course you want to multiply that by a 40-hour work week. This is assuming that we have somebody who works a full work week and it is indeed a full-time job. For that person, they would be earning approximately $680. What we would then do is do $680 times 52 weeks in the year. And that comes up with an annual income of $35,360. Now, to get their monthly qualifiable income, we need to divide that annual number by the amount of months in a year, which is 12. $35,360 divided by 12 equals $2,946.70 a month of qualifiable income. Things to take away for the hourly wage earner is we're going to be calculating not by what they think they make in a week, but what they make in the entire year, divided up by 52 weeks, and then divided by 12. One trap you're not going to want to fall into is to take whatever they make weekly, multiply it by 4, and then multiply that by 12 to get their annual and monthly income, because you're going to get a different number. In this case, if you tried to multiply the weekly income by 4, you'd have 680 times 4, and that would be $27.20 a month. So you're going to see a difference of $246.70 if you don't calculate this correctly. So remember, when you're qualifying an hourly wage earner, you're going to want to know what are the amount of hours you work at a week and what is the wage for that, and then multiply that by 52 for the weeks in the year, and then divide that big number by 12, and that is the monthly qualifiable income figure. So the next example of a salaried wage earner that we're going to be qualifying is the bi-weekly wage earner. And this is going to be divvied up into 26 pay periods, which is different than semi-monthly. So what you're going to want to do for the bi-weekly wage earner is you're going to take whatever the pay is for the bi-weekly periods and multiply that by 26. What we're then going to do is divide that number, just like the last time, into 12, which is 12 months in the year, and come up with the qualifiable monthly income. In this case, we have somebody that makes $2,000 every pay period. We're going to multiply that by 26 pay periods, and that's going to equal $52,000. Of course, we will divide that by 12, and that comes out to $4,333.30 in monthly qualifiable income. So again, if there's 26 pay periods, if that's the amount that you have to verify, that's going to be a different number than obviously the hourly wage earner and the semi-monthly, which I will get to. So you're going to want to pay attention because it's a very specific amount of pay periods. In this case, 26. 26 times 2,000 is going to be the number that you're going to want to divide by 12 in order to get the correct amount of qualifiable income in this case. One thing that you're going to want to avoid when you're calculating this type of income is doing the semi-monthly pay period, because there's going to be 24 pay periods in that, and obviously 26 pay periods in this type of income. So you're going to have two very different figures if you mix these two up. Okay, so the next example of the type of income we're going to want to verify and qualify is the semi-monthly pay period. Now this is the type of person that's going to be paid like on the 1st and the 15th of the month. So you're going to get 2 pay periods a month, and that's going to come out to 24 pay periods total for the year. This is one of the types of incomes that you're going to be seeing a lot of as a mortgage loan originator. So you want to look out for this because chances are if you're engaging with somebody who is an employee, in this case, this is going to be the structure that they're going to be working under. If we take a semi-monthly approach to the qualifying of this income, we're going to have a little bit of a different figure to qualify. If we take the same figure from the last person, that they make $2,000 every pay period, and then we multiply that by 24 pay periods, that's going to come out to $48,000 a year. Obviously, we're going to divide that by 12, and that will equal $4,000 in monthly qualifiable income. Now, did you catch that? Since we did the semi-monthly approach, you're going to come up with a $333 monthly differential of qualifiable income when compared to the bi-weekly pay period employee. So that can mean the difference between somebody qualifying for a loan and somebody not qualifying for a loan. So it's really important for you to know, hey, if I have $333 extra to work with when we get to the debt to income ratio, which I'll be talking about, yeah, that's really important. So make sure you're qualifying on the correct type of income. And finally, one of the most obvious ways that people can be paid every year is just once monthly. In fact, this is not as common as it used to be, but still, it goes without saying. We're going to take whatever the figure that they make per month and qualify them at that level, right? So if they get paid $4,000 a month, they have $4,000 of gross monthly qualifiable income. Here, we have the example of somebody who makes $3,620 a month. That is their gross qualifiable income. We can multiply that by 12 to come up with their annual income, which is $43,440 per year. But what we know is that they're already going to be able to be qualified at whatever the monthly amount is. The next kind of person that you're going to be qualifying on income, and one that is much more challenging than just a regular employee of a company, is going to be that of the self-employed earner. They, in fact, have their own underwriting forms that they have to fill out in order to be able to qualify. There's all sorts of underwriting questions that need to be answered and verified by you and your processor in order for them to be able to qualify on the amount of money that they're representing to you as having made every month. Because a lot of times these folks don't even really know what that amount is. They'll say they make $100,000 a month, but they'll do $75,000 of write-offs, and they'll have all sorts of other junk that goes into the leverage of their company, and all of a sudden they realize that they can't get the loan that they thought. That form is called the 1084 form. You're going to want to have the self-employed borrower work generally with your processor and the underwriter in order to fill that out very carefully so we can verify the amount of income that we can qualify on. One really obvious and really good rule of thumb is that we're going to be looking at the past 2 years of income, not only on their personal income level, but on the business income level, because a lot of times these people are people that own their own businesses and LLCs and things. What we're looking for is if there is an increase in earnings from the first to the second year, we're going to average the two and take that amount as their qualifiable annual income and divide that by 12 to get their monthly amount of qualifiable income. If the amount that they made from the first year to the second goes down, we will simply take the lesser of the 2 years, which is the most recent. One thing that is really important to note is that not only will we be calculating this way when it comes to the amount of income that they make, but all of the documents of both the bank statements of the company and the person in question, as well as the taxation records of the company and the person in question, have to corroborate the thing that they are representing to you in order to be qualified at that amount. I can't tell you how many times I've had a borrower or a potential client give me a certain number that adds up on their personal tax returns but doesn't add up on the business tax returns, or doesn't add up in the business bank statements, or doesn't add up on their personal statements. And then you've got a big mess on your hands that you have to have your processor and your underwriter sort of clean up. This is the reason that it is so very difficult for most lenders to qualify self-employed income. Okay, so the next thing I want to talk about is how we determine what the monthly amount of interest that is being paid on a loan is, and how we get that from the annual interest rate on offer when somebody purchases a house or does a refinance on a current loan. One really easy rule of thumb when you're calculating monthly interest rate is going to take 1 plus the annual rate, and that's going to be all to the exponent 112, which is the amount of months in the year, minus 1. So in this case, we want to divine what the monthly interest rate or what the monthly amount of interest that somebody will be paying on 2.75 annual rate would be. So we will take 1 plus 0.0275 all to the power of 1/12 minus 1. That equals 1.0275 to the power of 1/12 minus 1, or 1.0022632796 minus 1. That means that our monthly interest rate is going to be 0.0022633, or 0.23% per month. When somebody asks you what the monthly interest rate that you're going to be paying month to month is when you get a 2.75% loan from a bank or from a mortgage company, you can say that you're paying 0.23%. From that, we're going to be able to determine how we get our monthly payment. And this calculation is a little bit more in depth, but not too much. If we take it step by step, it's something that you're going to be able to do like second nature. For the formula, what you're going to want to remember is your monthly payment is going to be loan amount plus the monthly interest rate that we calculated before, all over 1 minus 1 plus the monthly interest rate again, and that's going to be to the power of negative however many payments there are in the amount of the loan. So in a 30-year loan, that's going to be 360. I know that sounds a little bit involved, but it's pretty simple. In this example, we want to determine what the monthly payment amount is going to be on a house that costs $799,000. So that means that we're going to have $799,000 times 0.0022633 all over 1 minus 1 plus 0.0022633 to the exponent negative 360, because it's a 30-year loan. Extrapolating out on that, you're going to have 1,808.3767 all over 1 minus 1.0022633 to the power of negative 360. Again, that means that you're going to have 1,808.3767 in the end over 0.55685902611. And that means when you do that math, that's a simple division, and you get a monthly payment amount of $3,247.46. Now the next thing is something that I get a lot of, and a lot of times I'll have to do off the cuff when maybe the internet isn't working, and it's not necessarily that something that's going to be on the test itself. Perhaps it is. I don't remember, I don't think that it was on my test, but it's going to be how to calculate an amortization schedule. I can't tell you how many times I've had a client say, yes, that's my amortization schedule, that's my monthly payment, but what if I did another $200 principal pay down every month? When would my payment end, right? And this is something that you're gonna have to be able to do more often than not off of the cuff. So right in front of the client, you're just gonna be like, oh, let me get my calculator out. And so here, I just want to get you in the mood to be able to sort of improvise if the time comes. So in order to do an amortization schedule, you're just gonna need two main pieces of information: what the initial balance is, and then what the interest rate is. You're going to take the initial balance times whatever the interest rate is, and then you're going to subtract that amount from the initial balance. That will give whoever the client is the amount that there's going to be left on the loan for the next year. And then you simply keep subtracting that amount for each subsequent year. For somebody who has a loan with a starting balance of $799,000, if we multiply that by 0.0022633, that comes out to a rough payment of $1,808.38. For the first year, what we're going to be seeing is $799,000 minus $1,808.38, and that's going to be equal to $797,191.62. This will serve as the initial balance for the next year, and then we will simply subtract that amount from each subsequent balance until the loan eventually amortizes. For this particular loan, you'll be doing this 360 times, as there are 360 months in 30 years. Bringing us back to qualifying on monthly gross annual income, we know what the amount that they make is, but there's a little bit more information that we need in order to be able to qualify them for a given loan. Specifically, we're going to need almost all of their credit obligations, less utilities and cell phone bills, to be able to put them into a formula and pop out a percent, which hopefully will qualify them or disqualify them in the process. This is called finding their debt to income ratio. The first information that sheds light on the qualification standards for a client is what I like to call the PITI payments, or the PITI. So in PITI, we've got the principal. That's the amount that we are lending to the person that we expect to get back. Then we have the interest. That's the amount that we are charging them. That's what makes it profitable for a given lender. And then we have the non-loan sort of oriented costs, which are the taxes, which are determined by the county tax assessor's office, and of course the insurance, which we need to legally have somebody live in a home in the United States. Some of that information is stuff that we give to them, like the principal and interest, and some of that information is stuff that we need to independently verify from them, like what insurance they choose, and where's the county in which they will be buying or refinancing the home. Now that we know what the principal and interest on this particular home is, we've gone through everything and we know what they'll be paying every month, what are the taxes and insurance? Well, if you want to figure out what any given county's taxes are on a home, you simply have to go to the county clerk's office or go online. You can usually do it on realtor.com or Zillow or somewhere, and they'll post the most recent year's tax bill for a certain home. For a home in Cook County, which is where we're taking the example for our last calculations, the amount that is usually taxed is 2.14% of the assessed value of the home. Now there's a difference between the actual value of the home and the assessed value of the home, and that is usually a percent of however much they think that the home is worth. So you could sell your home for a certain amount, and usually the amount that is reflected in the appraisal, or you could have your home assessed at a certain level and that will be taxed at that level. And that is something that you can actually dispute with the county if you think it was unfairly or incorrectly assessed. So if we took a home that is in Cook County and it is worth $799,000 times 0.0214, which is just 2.14%, right? We get an annual tax bill for that home at $17,098.60 per year. That comes out to a monthly obligation of $1,424.88 a month. It ain't easy living in Chicago if you're a homeowner. This is because that is just the tax bill. So you've already got the principal and interest payment. Now we're tacking on the tax bill monthly, right? And that is going to be juxtaposed with whatever their monthly qualifiable income is. So their income, the percent of their income that they're qualified for, has to be able to cover the tax and the principal and interest payments. The next thing we need to know is what their monthly insurance obligations are going to be. It merits saying that this is one of the things that borrowers often like to shop for. They don't take too many suggestions from you as to where they're going to get their insurance. This is something that the borrowers usually just prescribe to you and you plug it into your calculations. Let's just use a fictional value of $150 a month for the homeowner's insurance. That means if you're going to want this home at $799,000 in Cook County, Chicago, you're going to want to be able to obviously cover the principal and interest amount at $1,808 per month. But we're also going to want to tack on that more or less $1,425 a month plus the $150 a month. All of these obligations are going to be calculated in conjunction with things like car loans or second loans or HELOCs on the home, which I'll be talking about in other videos as well. They're going to be added together to come up with the monthly debt obligation figure. And that has to represent 49% usually or less. Usually folks are going to want it to be less, at least 42% or something. That's pretty safe, of their monthly qualifiable income as the debt to income ratio. One of the easier things to grasp in the mortgage industry is coming up with the idea of loan to value, right? We have the amount of the loan that the lender is providing relative to the amount of equity that the person will be taking in a home. So for example, in a $100,000 home, if a person is coming to us with a down payment of $20,000, that's 20% of the value of a home, the loan to value that is represented by the amount of money we are giving to them would be 80% or an 80% loan to value. The total or complete loan to value of a home is a little bit different, but not too much different. So for a complete loan to value, we're going to be taking all of the regular mortgage liens that are going to be on the home plus any other additional liens, like let's say they have a second mortgage or a HELOC or something. Those are going to be compiled to show how much the person has in actual equity in the home, not just relative to what our loan is looking like, but relative to the amount of equity that they actually have in the home. Let's say we're trying to refinance them and they want to refinance $35,000 on their $100,000 home, but they have a second mortgage and the second mortgage has an additional $10,000 on the home. Well, they would have $10,000 less equity, right? So it would be 35 plus 10,000. That means that the person would have a 55% stake equity in their home, and we would represent a 45% complete loan to value in this situation. The loan to value amount is really important when we're trying to calculate what a buyer's risk of default on any given loan is. This is something that is important to note when we're doing things like a FHA loan, which only requires a 3.5% down payment on that loan. As a contingency of that 3.5% payment, we're going to require that there is an upfront mortgage insurance premium so that we can make sure that if the buyer does default, we are somewhat covered by that payment. Banks in conventional loans usually don't like to give any more than 80%. So if we do like a 90% loan to value, then that's usually going to mean that we're going to want to insure the mortgage with a private mortgage insurance. And then on things like guaranteed loans, which are usually govies or government loans or USD loans, those have a 0% down payment, but those are in fact insured or guaranteed by the federal government, in this case the Veterans Administration or the USDA, for the amount that makes it viable for us to offer these products either to veterans or to people who live in more rural areas of the country. So guys, that's all I want to talk about in this video. I hope I brought you some value today, and if I did, again, please leave me that like. It really helps me out with the YouTube algorithm. And hopefully you're gonna hit that math section hard and get what you need to get out of this test so that you can go on to a massive career as a mortgage loan originator. And again, I will see you in the next video. Hopefully we're both gonna be a little bit richer and a little bit happier. Peace, guys.